Now we can also, tax-deferred gains is what we call a 1031 tax-deferred exchange. This is Section 1031 of the tax code allows us to sell our properties or relinquish them and buy more property of equal or greater value without having to pay the capital gains at that time. It's called a tax-deferred exchange. And there's some very strict rules on this deferred exchange, but it is also really the way to leverage and get into more property. Because what happens? Who's our biggest debt in our lifetime? Who's going to be our biggest debt over our lifetime? It's going to be Uncle Sam. Uncle Sam's going to take the most out of our income, out of our assets over time. So if we can do anything to not pay more than our fair share of taxes, then let's do it. Let's use the laws. Trump, love him or hate him, he's the one that said, I didn't pay taxes for years because he knew how to use real estate and real estate paper losses to wipe out his income in future years. But for us typical home buyers, you buy a house, say right now median price is $300,000. Let's just say you bought a $300,000 property. We're going to talk a little bit about the economy and what they're expected these prices to do here in Austin. But let's say it goes to $400,000, this investment property. What's your gain? $100,000. So if you sold it and it was more than a year, you'd pay 15% or thereabouts capital gains. So 15,000 of this money would go to Uncle Sam. But 1031 allows us to take this house and that's appreciated and buy more. So as like-kind property, which simply means investment property. So this is what I just recently did. I took a house in Round Rock that I paid $170 for back in 2005. It appreciated to $250, $260, sold it, and did a 1031 tax-deferred exchange. Did not pay any income tax on this. I deferred it into 2 properties in a suburb of Austin, and now I've got a property that has more cash flow because the property values were less. These are $150,000 houses, and the $250,000 house, you have to buy equal or greater value. And you have to follow the rules, specific rules on 1031 exchanges. You have to reinvest all the cash. You can't put the money in the pocket. You must reinvest the capital that comes out of it. You have 45 days to name the next property. There's a couple different rules, but the typical one that most people use is 3 property rules. You can name 3 properties. There's other rules, but 3 properties is usually what it is. And then you have 180 days from the sale of the relinquished property to close on it. And if you do all this, and you can't touch the money. Big important. You have to use what's called an accommodator. I don't know if I'm spelling it right. It's kind of like an escrow, but it's an official company that holds the money for you so that you don't touch it, because once you touch the capital, it's taxable. So this is a great way to build real estate wealth through the natural appreciation, but then avoiding or deferring the the income taxes into the next property and into the next property. And so you can do this, and you can see my father-in-law, who owns a bunch of property, he took a 4-plex in Huntington Beach and bought 6 houses here. And now he's taken these 6 houses and bought 14 houses. So all with tax-deferred money. Now, he's getting up there, and this is something that most people don't realize, but this is a great way to plan your estate. This is going to be cool. What happens is, now that he has all this property, and we'll just call it $5 million value, and he probably owns only about $1 million, if that. If he sold all this property the day before he passed, he'd get hit with what? He'd get hit with capital gains of 15% or more, He also have to pay back all that depreciation write-off he was enjoying that he wasn't paying the government. It's called depreciation recapture. That's a huge hit. Guess what though? Us heirs, the heirs, after he passes, gets what's called a stepped up basis. Which means the government says, oh, I'm so sorry about your father's passing. It's now this $5 million. We're going to call that, instead of the million that he really was, what he had into it, but this appreciated $5 million, we're just going to call it $5 million now as a stepped up basis where you don't have, now the kids could sell that and not pay any of the taxes that dad would have had to pay if he sold it the day before he passed. Does that make sense? Most people don't know this, but that's an incredible way to pass wealth onto your kids. By taking the deferred all this through his years, methodically buying and trading and exchanging and buying and building assets and then in real estate, and then when he goes to the sweet by and by, we get a stepped up basis, so we don't have to pay the income taxes that he would have. You could do this for your kids. I tell them to do it for our grandkids. They're just too cute. Okay, is that exciting? Yeah. Who wants to pay more taxes?